CIL 650 presents It's Your Money, an up-close and personal look at your finances. Here's your host, Fred Snyder.
Up in the morning and out to school. The teacher is teaching the
Okay, we're back. Once again, mind you, this now is a live show. Just listen to an hour of a replay. This show today is live. That means we take calls. That means you got a chance to telephone in, ask questions, make comments. And we have Frida down at the office. For those who are shy, reluctant to talk on the air, she can take your call down there. If you want to make an appointment to see myself for a second opinion on your investment portfolio, you want to develop and establish a written financial plan, all you have to do is call Frida, and you can reach Frida. Give the number out right now. Somebody once said, I give them out a little too fast, so I'm going to really slow down today on those numbers because we want and we invite your calls. The number to call for Frida is 604-737-3512. 604-737-3512. Maybe you heard something in the first hour where we were doing a replay, and now you want to make a comment or you have a question, give us a call. You can call us live at 604-280-0650. Should you be calling long distance, it's 1-877-280-0650. Now you can log on. It's live. You can see the screen. You can see the pictures. You can see what I look like, and so on. It's all there. www.cisl.650.com. Log on. Listen to us on your computer. I listened to the show that I did yesterday on Shannon Oaks on the Boomer Generation. It was a replay. Actually, it was live. It was a replay, but it was played yesterday. I listened to it at 11 a.m. It's about senior living. Okay, so good idea. Get on the line, give us a call. It's time to talk about the most important subject in the world, and that is your money and how to keep it. And if you do what most people do statistically, you won't keep much of it. You're going to work a lifetime, you're going to earn a small fortune, and you're not going to keep much of it. So it's time to get the numbers, and we're going to be talking a lot today about the numbers. You need to know your individual set of numbers, and good place to do that simply by making a phone call. I can do that live on the air. Simply call the number 604-280-0650. If you're calling long distance, it's 1-877-280-0650. Log on, www.cisl.650.com. Frida down at the office at 604-737-3512. Long distance, 800-661-1495. You just tuned in. I'm certified financial planner Fred Snyder, also a registered financial planner representing Scotia McLeod. And my mission, my purpose is to teach people what they need to know to be able to make better financial decisions, because your future financial success will depend on that. So again, we share this show with you, our listeners. We like to have conversations with you about your money, more importantly about your money and how to keep it. So get on the line, give us a call. So again, the station is, the name has been changed to CIL.650. And again, I have a little skit here just kind of as a reminder. This is one I picked up off the internet a while back. And we have a newborn baby, only 22,463 days left until retirement. But I can assure you that you're not a newborn baby, not if you're listening to this show and you're serious about it, so you don't even have that much time. So you got to start saving a part of everything you earn. We've talked many times about the fact that you can't spend everything that you earn. If you do, you're broke on payday. If you spend more than you earn, you're running up your credit cards on payday, because somehow you have to pay your expenses. And the only way you're going to be able to manage your expenses is to have a budget. So we provide software, we provide ways that you can do that. A budget is built into a financial plan, and the numbers are all laid out and crunched. We have Tracy from Langley on the telephone. Tracy, welcome to the program. Hi, Tracy. Are you there, Tracy?
Hello.
Hi, Tracy. How are you? You're on the air.
Hello.
Can you not hear me?
Hello.
Oh, I don't know what's going on with my system here.
Hello.
I can hear you.
Hello. 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 Hello.
Hello. Tracy, can you not hear me? I don't know what there's something wrong with the system, Dwayne. I don't know. Not sure what to do here. Okay, so Tracy, I couldn't hear you. If you want to call back, we got a technical problem of some kind or another. We have to fix that somehow. What's going on? No, but she couldn't hear me. I could hear her, but she couldn't hear me. Okay, why don't we take a break and try to fix it? Okay. All right, so if you just tuned in, sorry about all that. I don't know what's going on. I got Don from Langley on the line right now. Don, welcome to the program.
Oh, hi, Fred.
Hi, Don. Can you hear me okay?
Yeah, fine, beautiful.
Okay, well then, Tracy.
I got a few problems, but I don't want them aired on the air.
Okay.
Could you give me a call after the show?
Be very happy to give you a call, sure.
What time is the show over?
Show's over at 11.
11. Okay, Fred.
So I
Thank
will
you
call
very
you
much. You got my
when I
number?
leave the station right after 11, about 5 after 11.
Okay, Frida's got my number.
Okay.
I can give it to you now if you want.
No, I have it.
Oh, you have it?
It's not a problem. I'll call you after the show.
Oh, okay. Thank you very much.
Don, you have any questions or comments?
Not really.
Okay.
I got some questions, but I don't want them aired. She said,
Okay.
I don't want anybody blackmailed or some stupid thing like that. Well, I don't want anybody. Cause but I just want to talk to you off the air.
Yeah, okay, no problem.
Thank you.
You take care. Bye for
Bye.
now. Okay, Don's line is now open, so if you're out there, you're listening to the show. I'm certified financial planner Fred Snyder, also registered financial planner. We're talking about your money, more importantly about your money and how to keep it. And there's only 22,463 days left until retirement if you're a newborn baby, but you don't have that much time. And your success will depend upon how well you manage your time. That's what it's all about. So get on the line and give us a call. Your questions or comments are most welcome. So again, you're listening to CIL 650, and I'm certified financial planner Fred Snyder, also registered financial planner. And once again, we're talking about your money, more importantly about your money and how to keep it. So get on the line and give us a call. I'm going to get my number cruncher up here. And this here, many of you are probably not on the internet, so you don't see it. But this here is a piece of software which I have and I use for developing financial plans and crunching the numbers. So this case study, if you want, is for a person who's 70 years of age and retired, who wants an annual income of $100,000 and receives a pension plan of $20,000, so already has 20 of the 100. Assumes that inflation is going to be 3%, presumes they're going to live for at least 20 years. They want the money to last for 20 years. That's until age 90. Assumes that the annual inflation rate is 1%. It probably should be 3%. And in fact, I think I'm going to change that variable right now. So if I put 3% in there, I think that's more realistic. And they have $500,000 of what we call net working assets. That is the assets that they have. That's their investments. It doesn't include your house. They can save $10,000 a year in a TFSA and outside. They assume that the inflation will increase by 3%. They get a return on their money of 10%, which is probably high, not guaranteed. We're assuming that before retirement, and 10% after retirement, and seeing how they're already retired, it's 10%. And we're going to use an investment uncertainty of 1%. That means they either get 9, 10, or 11. So the variation in the rate of return is there. And we can do the calculations on that, and we can say, how long will that money last? Well, that person, if they retire at 70, the blue lines represents the income. So the first year is the income, and that's $100,000. The second year is the income, and that's $103,000 because of the 3% for inflation. The next year it's $106,090, and so on. That person will run out of money at age 78. 8 years. They go through $500,000 based on those numbers. And that's probably not satisfactory. So what can that person do to make sure that that money lasts as long as they do? So if we go back to the variables and we say, okay, you don't save any money, can't afford to save any money, so let's take that $10,000 out. So that's out. Let's say that the rate of return, we'll leave it at 10 because it probably has to be. They're 70 now. They still have 100,000. They get a pension benefit of 20,000. We don't want to take that out because that won't help. So we do the calculations on that. How long does the money last? It lasts still till only age 78. It doesn't fix it. Okay? So if we go back to the numbers again, and we say, what can we do to make that money last as long as that particular person lives? So maybe maybe we need the retirement period to be 35 years, or say 30 years. So if we put in 30, oh, I got a problem with my software here now. Nothing seems to be working right today. Okay, so I have to shut this down because I just pushed the wrong key and I can't fix it. So again, the bottom line is very simple. You have to get your own set of numbers and you have to lay them out. This is difficult. Let's see here. Okay, so what we did here, we have a person who's 70. They want to retire at 70. They're already retired essentially. They want $100,000 a year of income. They have 20,000 of that already, so that means they've got to make up 80,000, and they got to get the 80,000 to come from the 500,000 of net working assets that they already have. And the question is, how long will the money last? Okay, that's the big question. So if I'm going to go back and do my calculations on that and see if it worked, it's okay. I didn't mess it up. So we extended the income to about 79.5 now, simply by making a couple of minor modifications. And maybe that's okay for that person. Maybe that person expects that they only want the money to last until they're 79.5. But generally not. Okay? Generally not. They want that money to last as long as they do. If that money was invested in the GLWB, that income stream line at the bottom even continues after they run out of money. So even if the money went down, the income continues because it's a GLWB. So here you have the data that creates those variables, or these are the variables that create those numbers. So let's say that we had somebody who was 65. So you got a 65-year-old person, and they want to retire at 70. And they want the same numbers. Or let's say they only want 80,000. So they only want 80,000. They already have from a pension 20,000. So they want to get 80,000 of income. And again, the question is, how long will the money last? If I put a rate of inflation in there of 3%, which is more realistic, I think, than 1, and let's say that I cut the rate of return to 7%, which I think is more realistic than 10, and I use the range of investment uncertainty as 2%, either side of the 7%. In other words, they might get 9% or they might get 5%. The projection is right in the middle at 7. How will that set of numbers work? Well, that money then, that person will run out of money at age 83. If they get 1 or 2% less, they'll run out of money at 81. If they get 2% more, they'll run out of money. They're almost 86. Now, I don't know what these numbers are going to be for most people, and nobody really does, because we're not dealing with guaranteed numbers here. But we have to make projections. We have to do the planning. Okay? So here we have, if you look at the chart, we have the accumulation period here when the person starts out. So there's no income coming out. That's that green line. And up here, then the green line reverses and starts going down because now you're drawing income out of that particular plan. So once again, the income that we're drawing out of there is $80,000 a year. $20,000 of that is the annual pension benefits, OAP, CPP, and pension plan that this particular person might have. So they need to pull out 60,000 inflation-adjusted dollars out of 500,000 that's earning, say, 7%. How long will the money last? And if you're projecting that you need this income to live in a senior living home like Shannon Oaks is an example, this is one way that you can get the income that you need. There's lots of other ways. There's lots of options. I represent Scotia McLeod. We're really a financial department store. We have almost every financial product that's out there. There's very little that we don't have. There's about 21,000 investment funds that are offered to the public. And I have a methodology of picking the best funds so that we always have the 10 best funds in our portfolios. That's one thing to consider. So, and then we have the GLWB products that are out there, which give you a guaranteed lifetime withdrawal benefit plan, where you get an income from that. So we have all that. So once again, get on the line, give us a call. 604-280-0650. If you're calling long distance, it's 877-280-0650. Log on, www.cisl.650.com. And Frida, for those who are shy or reluctant to talk on the air, is down at the office right now. Area code 604-737-3512. If you're calling long distance, it's 800-661-1495. We're talking about your money, more importantly about your money and how to keep it. And sorry about the glitch there a little earlier. Whoever that caller was, I don't recall the name right now, but if you're out there, feel free to call, give us a call back. Appreciate it very much. So again, how much money have you earned so far during your lifetime? How much of that do you have left today? Are you happy with the answers? You're probably not, and if you're not, what are you going to do about it? Maybe it's time to get yourself a written financial plan. So if you call us here on the air, live, you get no obligation, no cost, written financial plan. All the numbers are crunched. The numbers we're talking about right now will be personalized for you. If you want to call us right now, you might say to me, well, hey, why don't you run my numbers right now? So get on the line and give us a call. We'll run your numbers, and you might have $500,000 to invest, or maybe you got $1 million, or maybe you only got $250,000. But you want to draw an income from that money, and you want to know how long is it going to last. Is it going to last 5 years, 10 years, 15 years? Is it going to last as long as I do? Because that's what has to happen. So if you give us a call and you say, I have $250,000 to invest and I'm 60 and I want to retire at 65, excuse me, what do my retirement numbers look like? So again, how long have I worked? How much money have I made? How much of that do I have left today? And am I happy with the answers? And if I'm not, am I going to do something about it? It's time to get yourself a financial plan if you're not happy with the way your money's working for you. So get your investment portfolio analyzed. Get an MRI on your investment portfolio. Get a written second opinion prepared by a CFA. Somebody who will look at your portfolio and say it's too risky, or it's not risky enough, or it's not performing. The rate of return that you need. What rate of return do you need to achieve your financial objectives? What rate of return do you need to achieve your financial objectives? And if you don't get that rate of return, then you're going to fail financially because you won't achieve your objectives. And what are your objectives? Do you have any? Have you ever figured out that the day I retire, I want an income of $50,000 a year? Or I want an income of $30,000? Or $100,000? I don't know. It's up to you. Your hopes, your plans, your dreams, and your ambitions depend upon one thing. and that's the money. You need to be able to carry them out. Are you going to have that money the day you want to put your feet up and relax and not work anymore? Or are you going to work until you drop? Two critical questions. How long have I worked? How much money have I made? How much of that do I have left today? And am I happy with the answers? Statistically, 100 people starting out equal today at the age of 25. By the time they're 65, 1 is rich, 4 are well-to-do, 5 are still working, 36 are dead, and the balance is 54 people. They're dead broke, dependent on family and state. Now, let's just suppose I did a seminar out at Shannon Oaks, and I asked the audience, I said, if I could extend everybody's lives to 130 just by waving a magic wand, how many people would take me up on that? And almost every hand went up. And I said, okay, so you're all going to live to be 130. How long is your money going to live? So if you run out of money, if you live to be 130 and you run out of money at 90, you're broke for a long time. Not good. So health and wealth kind of go hand in hand. I used to do some shows on here occasionally with Dr. Don Nixdorf. Used to talk about that a lot. Is your money going to live as long as you? And it's really all about income. If you're saving money on a systematic basis and you're actively investing money and accumulating money and you're watching your money grow, why are you doing that? What are you going to do with that great big bag of money? You can't take it with you when you die. So at some particular point in your life, you have to say, I got to stop saving and I got to start spending. I got to spend some of that 500,000 or million, whatever it is. So how do I do that? How do I do the calculations? And once again, at the risk of sounding like a broken record, it's about the numbers. It's about the numbers, stupid, as they used to say about the economy in the United States. It's really, what is your individual set of numbers? How old am I today? When do I want to retire? What income? How much income do I need the day that I retire? Define my lifestyle. Do I need 30,000, 40,000, 50,000, 100,000 a year? How much income do I need the day that I retire? How much can I spend in my golden years? How much do I need to spend? How much do I want to spend? These are all questions that need to be answered. So if I need to spend $50,000 a year to live, and that would be a pretty good average, that's a little more than $4,000 a month. How much of that $4,000 have I already established? Well, if you don't retire until you're 65, you're going to get the old age pension in the Canada Pension Plan, which is about $1,500 a month in today's dollars. Okay, so you got that. Do you have a private pension? Do you have a government pension, superannuation? Maybe you're a teacher, whatever. Do I have a pension plan? And then do I have an investment plan? What are my net working assets? Should I include my house in my calculations or not? Do I have a plan that's minimized or maximized my income tax situation so that I don't pay more tax than I need to? Have I protected myself against risk? What happens if I die or become disabled? What happens to my property when I die? The government deems it to be sold, and you got to pay the tax on it. So there's two ways you trigger tax on your assets. You give them away, you trigger tax. You die, you trigger tax. How do I do all those kind of things? There's lots of questions, and for every question there's an answer. And the only dumb question is the one you don't ask. Okay? So if you're concerned about your money, if you're worried about your money, if you don't know what your numbers are, it's time to make a change. Not to continue doing the same thing over and over and over again. As Einstein once said, that's the definition of insanity, doing the same things over and over and over again and expecting a different result. So if you failed financially in the past, what are you doing that's different this time? Let's talk to Rob from Vancouver Island. Rob, welcome to the program.
Hi, Fred.
Hi, Rob. How you doing?
Good. Couple of questions.
Sure.
A retiree, so no new income to put away.
Yes.
I have accounts with you, so my TSFAs are topped up. I've got money in both spousal and my own RRSPs,
Mm-hmm.
and then money outside in the middle.
Mm-hmm.
So just came into a bit of an inheritance,
Mm-hmm.
which will have to get put in the middle.
Mm-hmm.
I'm guessing. There's no point in putting it in the RRSP at this point because I'm in a low tax bracket. Is it smart for me at age 61, and I've done this before, at age 71 I'll have to start liquidating my RRSP, that's correct?
Well, that's a really, really good question. And can I take a minute or so to answer that one?
Okay.
Yeah, because there's lots of people get very confused about this. They say, I got to see you. I'm in a panic. I need to see you because I got to turn my RSP into a RIF. But you don't have to make any changes in your investments. You just call it a RIF instead of an RSP. The investments can stay exactly the same. You may need to change them. Maybe they should be changed, but they don't. You don't have to. So when the moment for the RIF comes along, which is the end of the year you turn 71, by the end of the year you turn 71, you have to convert your RSP to what's called a RIF.
Right.
But you don't have to change the investments. You need to understand that. Okay. Now, that year, at the moment you convert it to a RIF, you're subject to being forced to take a minimum withdrawal.
And pay the tax on it.
And pay the tax minimum. You can take anything out you want. You can take the whole thing out you want if you want to pay the tax.
Right.
But you're forced to make a minimum. You have no choice. You have to start withdrawing.
Right.
According to a schedule. And it's about 7.3% when you're 71. But you don't have, what some people don't understand is you don't have to make that withdrawal until you're 72. You have to set it up by the end of the year you turn 71, but you don't have to make the first withdrawal until you're 72.
Right.
And sometimes not making that withdrawal in the year you're 71 will avoid clawback on the old age pension. If you can defer it for another year, that's a good idea.
So my question is, I'm not eligible for OAP for another 4 years.
Okay, when you're 65, that's correct.
So my question is, my thought is, should I be taking out maybe $5,000 a year out of my RSP, putting it into the TSFA, paying the tax on the lower bracket now, rather than getting stuck later where I have to pay the tax?
Well, that's certainly a consideration. You got to get a sharp pencil out and do the calculations. But theoretically, if you're in a low bracket, you're better off to start taking some out, because that way maybe you won't be taxed as much as if you wait until you're 71
That's
or
what
72.
I was thinking.
Yeah.
So
But you got to do the calculations on that. I don't know the numbers, but next time I see you, I'd be happy to do that.
Yeah, I'll be seeing you soon. The other question I had is, I've only ever done mutual funds, but my brother dabbled in, well, not quite day trading, but looked after his own finances.
Sure.
And just watching recently, like the markets did a 10% drop, and oil's down right now below $80, and so if you owned individual stocks, or if you were in the Toronto stock market and it loses 10% in a day, if you're in a mutual fund, like I know you recommend one all the time that we won't name, does it give you more cushion? Like,
well, it's supposed to. It doesn't always. What happens is risk in the stock market fluctuations, stock market volatility, is called systematic risk. The chosen investments is called unsystematic risk. It's easier to choose investments that perform. It's easier to manage unsystematic risk than it is the systematic risk in the market itself. So the bottom line is that a good mutual fund manager is probably going to be able to make forecasts and see that coming and not be poorly positioned in the case of a market meltdown. But that's not always the case. If you take a look at the 21,000 or so investment funds that are out there, the returns are all over the map.
Right.
And they're all managed by supposedly skillful people. But some of them, on their track records, indicate they're not so skillful. It's very hard to time the market and predict what the market's going to do. If I knew somebody that could do that, and I know lots of professional money managers throughout Canada I'd be on the phone every day saying, give me your read on the market. Most of them don't know. They really don't. They can make forecasts. What they do, they look at the market and they look at what's called the leading economic indicators, which is like housing starts, changes in income, durables, the stock market itself. And these indicators give them an idea of what to expect in the future. It's not always 100% accurate. That's the problem, because you can get some kind of a event which disrupts the market. One of the reasons the U.S. market did poorly last year was simply the weather. That wasn't necessarily predictable.
So my last question to you, with the Canadian dollar being at its lowest point in 6 years,
yes,
right now, is that good for our investments?
Well, first off, if your investments are denominated in Canadian dollars and the dollar goes down in value, that affects your investments. If the market put your investments up 10% and the currency went down 10%, it'd be neutral. It'd be an offset. So the strong Canadian dollar helps the Canadian markets and the investors that are in them. On the other side of the coin, you need to be an economist. The lower Canadian dollar makes it easier to export Canadian goods and sell them. So, that's the job of a professional money manager. So if you have individual stocks in your portfolio, which is what you're talking about, if you have some individual stocks, you have to trade. You have to buy low and sell high. You got to constantly buy low and sell high. That's what professional money managers do with mutual funds. So if you have individual stocks, who's making the investment decisions? Is it you or your broker? Or is it some professional? So when you invest in a mutual fund, the mutual fund pools the money along with other investors, and hires a professional money manager to manage that pool of assets, or a team of professional money managers. But what you have is professional management with a mutual fund, when individual stocks, not necessarily so.
Right.
And what should you do? I do an analysis of your portfolio, and we have the expected rate of return based on history already defined, and usually that expected rate of return is pretty solid. My model, one of my model portfolios, the one that I like the most, which is the balanced one, the rate of return on 5 years is about 12% compounded annually now.
I think I'm in Fund 7.
That's a little more aggressive than that one, but it's the same funds. There's 10 funds, and they're all top funds.
Yeah.
In 7, the weightings in the equities is greater than it is in 5. But the bottom line is 5, 6, and 7 are pretty much balanced funds, balanced portfolios.
Right.
And historically, the numbers in those portfolios are pretty good. But remember, they're not guaranteed.
No, I fully realize that. Having gone through 2008, I understand that nothing's guaranteed out there in the world.
Yeah.
Anyway, Fred.
So I guess I'll be talking to you soon.
Yeah, I will. And I've been really, really happy with the way you've helped us manage our money, and even more so, my wife is happy, which is even better.
So you're well in your comfort zone.
Yeah. Anyway,
Rob, I can't tell how much I appreciate your call.
We'll talk to you again soon.
Enjoy the rest of the weekend. Take care.
You too, Fred.
Okay, Rob's line is now open, and all our lines are now wide open, and we have to go to the break. So when we come back, we'll take more of your calls. Don't go away.
Fred Snyder.
I want people to call the show that are genuinely interested in increasing their financial IQ so that they can become financially independent sooner and stay financially independent longer.
Fred Snyder.
You don't have a blueprint. Imagine trying to build a house without a blueprint. And how about having a blueprint for your life? What are your lifestyle goals? You need to think about your family life. What are your goals about your family life? What are your lifestyle goals when it comes to health? What are your lifestyle goals when it comes to finances, mental and spiritual? You have to set goals in all those areas, not just finances.
Fred Snyder.
Often we fail because we put too much emphasis on one area and ignore everything else. We work our butts off and we ruin our health. So life is all about balance. So you need a life plan.
Fred Snyder.
Napoleon Hill says this, wrote the book Think and Grow Rich. Anything that you can vividly imagine, ardently desire, and enthusiastically act upon will inevitably come to pass.
Fred Snyder.
My goal, my mission is to help people enhance their financial IQs by teaching them what they need to know to make better financial decisions.
Fred Snyder. Sunday mornings at 9 on CIL 650. This is CISL Vancouver. Smooth and easy. CIL 650. CIL 650. Welcome back to It's Your Money on CIL 650. If you have a question for Fred, call 604-280-0650. Now, back to Fred.
Okay, we're back, and I remind you once again we're live. We're kind of been talking about crunching numbers, and again, what are your individual numbers? How old are you now? What age do you want to retire? How much income do you want? Should that be inflation adjusted? How long are we going to live? What's the inflation rate if I do adjust for inflation? And how much money have I accumulated already? And how do I take those parameters and put those together and crunch some numbers where it lays out what the bottom line is? So in this particular case, I got this example. And again, based on the scenario that I have here, and I'll just load this back. This person is 65 and wants to retire at age 70. They have an annual income, or they want an annual income of $80,000. They wanted that to be inflation adjusted at 3%. They're going to be retired for 30 years, so that means they want to retire at 65, so add 30 years onto that, that's 85. They've accumulated $500,000, and lots of people listening to this show right now are in that position. You're out there, you have $500,000 to invest. How can I invest that $500,000 and make sure that money lasts as long as I do? How can I do that? Okay, so based on those parameters, what does it look like? Well, this particular person is 65 right now. They've accumulated this money. They'll run out of money at age 78. And if they're still alive, let's say they live to be 90, they'll be broke for over 10 years. Doesn't work. So you got to fix that. So how do you adjust those numbers to fix that? Isn't necessarily an easy thing to do. But if I go back and I say, well, what if the inflation rate was I'm going to leave 3%. I'm uncomfortable projecting less than 3%. It's not realistic. I think 3% is realistic. Maybe it's going to be 4%. I'm going to say, what if I get a return of 10%? Now that's getting pretty aggressive. What if I do? Then how long will the money last? So the rate of return is that the money now lasts until I'm 83. Okay? Still doesn't work. If I look at the individual numbers, my desired retirement income will be $92,742 when I'm 70. Because remember, it's an inflation-adjusted number. That's 80. That's what 80,000 will be the same as 92,000 if you're. That's just 5 years down the road because of inflation. So you see, this is a very complicated spreadsheet. These are complicated numbers, and I run out of money at 83, and the next year I'm in the hole 106,000 to support that. But you got to know. You can't wait until the last minute to know what the numbers are and then try to fix it, because it's too late to fix it. So it's time to do that. Let's talk to George from Vancouver. George, welcome to the program.
Yeah. Hi, Fred.
Hi, George.
You know, I don't know. I've got about somewhere between $225,000 and $250,000 of money, and I don't have like an investment guy, like a plan or anything like that, because I don't know where to go. I don't know who to trust. I've gone to people. I mean, one guy will tell me one thing, another guy will tell me something else. I'll do up a portfolio, and he'll say this is low risk. I'll take it to someone else. I'll look at it and say, well, this isn't a low risk portfolio. This is a high risk portfolio. And I know people who have, who had portfolios. They've gone and got second opinions where, where they're told, say, well, look, I can do you up a portfolio that'll give you a lot better returns, and you're getting at no greater risk. They take it back to the guy they're with, and he says, well, this is a high risk portfolio. So, this is.
But that is not. But George, that issue of risk is not a judgment call. The risk is measured by standard deviation. It's black and white. So you can take your portfolio and have a proper MRI done in your portfolio, and you'll get a written report saying that the standard deviation on the portfolio, scale of 1 to 10, 10 being moderate and 1 being 0, you get a standard deviation measurement on that portfolio that says it's 3.5. So on a scale of 1 to 10, 10 being moderate, it's only 3.5. That's reasonably low risk. That's the amount of volatility. And that's clearly measurable in a written financial plan. It's in writing.
Yeah.
So what are we talking about here?
Well, I don't know. I mean, to me, I know people that think, I don't put money in RSPs, and they're like, well, why not?
Well, if you don't do that, George, if you don't put money away for your future, what are the other options?
Well, I don't know. I mean, I put it in the bank. It's safe, isn't it? I mean, if the markets crash like they did in 2008, how much money, how much would you lose out of your portfolio? I mean,
well, if you put it in the bank and it's safe, I know your principal is guaranteed if you do that, and maybe you get 2% rate of return, but the return is taxable. So if you get a 2% rate of return in the bank that's taxable, your real rate of return is somewhere between 1 and 1.2%, depending on your tax bracket.
Well,
if inflation is 3%, you're negative 2%. That means you're losing 2% a year.
Yeah, and then you put money, you invest it in things. I mean, if I've got a whole bunch of money in an RSP, I mean, I've worked all my life to build up an RSP, and then I retire, and then I decide I want to start taking money out. Then I got to pay tax on it. I get charged. I mean, why should I be taxed on my money? To me, that's
because George, if you put $10,000 a year into an RRSP, you got a $4,000 a year tax refund. So you got $10,000 worth of investments for a cost of $6,000. So when you take the money out, the government says we want some of that tax that we let you not pay on those savings. We want some of that money back, so we're going to tax you on anything that you withdraw. That's not 100% fair, but I can't judge that. That's the law. And it's like, remember this again, if you put $10,000 into an RRSP, you're going to get a tax refund of $4,000. You really got $10,000 worth of investments that's growing tax sheltered at a cost of only $6,000. So sooner or later you got to pay some of that tax back. Hopefully you pay it back when you're in a lower tax bracket down the road.
Yeah.
But I don't have any perfect solutions. The best financial plan in the world is not 100% guaranteed, but it enhances the probability of success. And what I'm saying to you is, you have no chance of success if you wander around like a wandering generality, and you don't have any goals or designs or any financial plan. You need those things. I just had a caller from Vancouver Island call earlier. Says very happy with his investments. I reviewed about 20 accounts last week. Never had one account that I reviewed that wasn't happy.
Well, yeah. Well, like I said, I don't know.
So, and again, I've offered the book, How to Find a Financial Planner, several times on this show to all callers, and I'm going to offer it again based on this call. So if you call the show, you will get a book, How to Find a Financial Planner. And maybe you should pick that book up, or no, you don't have to. I'll send you one. You should read that book. And again, I suggest to you, if you're uncomfortable with the advice that you get from a financial advisor, ask for referrals. Say, look, I'd like to talk to one of your clients, somebody that you've dealt with for at least 10 years. That's fair. I'd be happy to do that with the permission of my client. But I can give you a list of probably half a dozen of my clients that you can call and say, what kind of a guy is Snyder?
Well, it's something I'm going to have to think about, I guess.
I was on the ethics committee for the Canadian Association of Financial Planners, and there are some very ethical financial advisors out there. I had a lady in my office last week that's dealing with a financial advisor whom I know, and she's got a lot of money. And she said, "How am I doing?" And I said, frankly, quite well. I don't think I can do any better than you're already doing. And she was stunned. She said, "I thought you were going to just tell me automatically that what I'm doing is no good." I said, "What you're doing is fabulous. Your advisor is doing a good job." And that's called ethics.
Yeah, well.
So I'm controlled by ethics, and I try to live by ethics, and I try to provide proper advice to people. And I'm a CFP and an RFP, so I'm regulated. I'm regulated by 2 professional associations. I'm regulated by IROG. I'm regulated by the Insurance Council. So what I do is regulated. And the last thing in the world that I want to do is be unethical. And I know there are unethical people out there. I'm well aware of that, and I can hear your frustration.
Yeah.
Okay? So
Okay.
if you want to take it to the next level, give Frida a call.
Yeah, I'll have to give it some thought. Okay.
George, can't tell you how much I appreciate your call. You take
Thank
care.
you. Okay.
Bye for now. Let's talk to Bernard from Richmond. Bernard, welcome to the program.
Hey, Fred.
Hi, Bernard. How you doing?
Good. Just wanted to talk about the TFSA. I was hearing the new rules. They might increase that, which could be really good. Maybe you wanted to elaborate on that?
Well, a TFSA, the contributions that you put, the money you put in is not tax deductible. The earnings that you make on it, you never pay tax on it. You can put money in and you can take it out. You can put it back, but you can't put it back the same year you take it out. If you do, it's called an overcontribution. And when people come to see me and they make investments, I don't know. There's no way I can tell how much they've invested, because they take the value of their account, and there could be a big difference between what their account is worth and what they actually invested at that time. They sometimes ask me to find out for them, and the only way you can really find out is call Revenue Canada or CRA, and they're not going to give me information because of confidentiality issues. So everybody who participates in a TFSA should, before they make a contribution, call CRA and ask them, what's my maximum limit? And that way you won't make an overcontribution and have to pay a penalty.
Okay. So that's the best way to find out where
And
you're
the
at.
underlying investments inside the TFSA can be almost anything.
Yeah.
You can have individual stocks, you can have mutual funds, you can have segregated mutual funds. Any investment product that's available out there can be inside a TFSA. My favorite mutual fund, my model portfolio 10 or model portfolio 6 could be inside a TFSA. The TFSA is like having a box that's labeled TFSA, and inside that you put your investments, and you can choose those investments within some restrictions, but not very.
So for a person that's never contributed from the inception of it, what would the value of that you could put into a TFSA today?
Today would be $31,000, and January the 1st, add another $5,500 to that, and that's the increase it.
Okay. Okay, fantastic.
And if you have a spouse, be the same thing.
Yeah.
So that's a lot of money to be able to put in tax sheltered. Everybody listening to this show, if they don't like paying income tax, probably the TFSA is the best way to do it, because you never pay tax on that. One of my callers earlier complained about paying tax on the RSP. Well, what he should do is have a TFSA. Or what people should really do is if you make a $10,000 contribution to an RSP, you save yourself $4,000 in tax. You put that $4,000 into a TFSA. So your investment then is $10,000. $6,000 is the net contribution. $10,000 is the contribution to the RSP. That's what you got working inside the RSP. The refund from that RSP contribution is $4,000. That money goes into a TFSA. Your total cash outlay is $10,000.
Okay.
So for $10,000, you got $14,000. You got $10,000 in an RSP, and you got $4,000 in a TFSA. $14,000 worth of investments. Cash outlay $10,000. Sounds like a plan.
Yeah. And if you have an existing investment, you could transfer it to the TFSA?
Providing it qualifies, and it likely would, yes.
Okay. Okay, well, thanks very much. I really enjoy your program.
Okay, Bernard, and you need to get in to see me pretty soon.
Yeah, for sure.
Okay, give Frida a call. Appreciate the call.
Okay, thank you.
Okay, bye-bye. Okay, if you just joined us, I am certified financial planner Fred Snyder, also registered financial planner representing Scotia McLeod. And again, we're talking about your money, more importantly about your money and how to keep it, and we're taking your calls. And we have Lisa from Coquitlam on the line. Lisa, welcome to the program.
Hi.
Hi, Lisa.
Hi. I just have a question. My daughter's boyfriend of 3 years, his mother just died last month, and she has left everything to him in his will, and she has a house that he has to sell because he can't afford to keep it. He's only 19 years old, and he's going to have a couple $100,000 from the sale of the house. And, you know, I think for him at such a young age, it's important for him to see a financial planner and invest that money so they don't do anything ridiculous with it and secure their future. And I've been talking to him about this for the last couple of weeks. It's still a sensitive subject because it's so close, but he, you know, he's listening. And I'm just wondering, like, what can I tell him, like, that'll convince him to do this?
Well, you got to motivate him somehow. And and he's probably not very motivated at 19. So how does a 19-year-old think? A 19-year-old thinks and says, well, you know, I don't want to invest right now. I need to buy a car. He's probably chasing girls around and stuff like that. So he wants.
Yeah, his mom did leave him a car, and you know that's in the garage. But you know he seems quite motivated. But you know, is that someone that you can help?
Oh, sure, of course.
Start his portfolio off.
The younger you are, the better, because the one thing you have is an abundance of time. You got lots of time if you're 19.
Right.
If you're 64 and you want to retire at 65, you haven't got much time.
Right.
Okay,
and
so the more time you have, the better. And really, when you look at money, what is the most important thing in the accumulation of money? Is it the amount you invest? Is it the rate of return? Or is it time? And clearly it's time. Time is the most important of the three. The more time you use up, or the more time you waste, the greater return that you have to make to catch up. You need a faster car. Okay, that means more risk.
Yeah,
and that's the problem. So somebody who's young can invest, and in fact, I'm going to use this just as an example. It's really quite a good example. So he's 19 right now, right?
Right.
I never tried this on somebody that young. This is new software, so bear with me. So he's 19. At what age would he like to retire? 65, 60?
Yeah. Well, ideally, he'd probably like to retire as young as possible.
I know.
So, you know.
Well, I'm going to say 55.
Okay.
Like Freedom 55. Now, how much income would he consider to be enough? How much does he earn now?
Well, right now he's just working part-time at a restaurant, so he's only earning about $1,000 a month.
Okay. Well, let's say he wants an income of $25,000 a year. Which is a lot more than he's making now.
Right.
And how much is the inheritance?
By the time the sale of the house goes through, so nothing's for sure yet. It'll only be about $350,000.
Okay, so he's got $350,000. We call that net working assets. So whether my thing will work with this or not, sure it works. The bottom line is that when he is at retirement, he's got incredible. He's got $11 million.
Wow.
Okay. Now remember, when we talked about the numbers, I'm projecting 10%. That's too high. I'm going to use 5. Because he's young, he's got lots of time. I'm reasonably sure that that's not a crazy number to project. So he ends up at retirement with $2,056,000.
Mm-hmm.
Okay. There's the chart. Anybody who's out there looking, there's today. He's 19. There's retirement there. That's age 55. That's his capital. That's his income down there. It's inflation adjusted. So if I look at his income, the first year, it's $72,457. That's that's future dollars based on 50,000 today, or no, 25,000. 25,000 a year today translates into 72,457 when he is 60 or 55. Okay, so whatever these numbers are, it's important to get them, and we provide a printout of this, and this is your roadmap. It's right there, and it's just a keystroke to make a change. I can play what if with this. What if he wanted to retire at 40? What happens if he delayed retirement to 65? I got the numbers. Right. It's just a keystroke.
Yeah.
It's not 10,000 calculations.
Okay. Yes, I got to tell him that.
So you got to call Frida, and you can reach Frida at 604-737-3512. Give her a call, make an appointment, and come on in. Bring him in.
Yeah, I will do that because I've been telling him I listen to your show every Sunday too, and I said you got to go talk to him.
Yeah.
So I just was looking for some more words to persuade him to do it as fast as possible. So
get him. Well, trick him somehow. Okay. Get him to read the book Think and Grow Rich.
Yeah.
That's a free download on the internet.
Okay.
Get him to read The Wealthy Barber by David Chilton.
Yeah.
Get him to go online. There's every bank has financial calculators. Get him to listen to this radio show.
Yeah.
But someone once said you walk a mile and then you can see further.
Yeah.
You got to kind of get them started.
Yeah.
We don't know what we don't know. And the bottom line is the more you know, the more you want to know.
Exactly.
So it's a process. I know when I went to high school, I hated French and Latin. and today, I love them.
Oh, really? Yeah.
If I was back in school right now, I'd be getting honors in French.
Yeah, that's true.
But I wasn't interested in that stuff when I was 18 or 17 or whatever. I couldn't see the point.
Exactly. And that's the thing. Like, he thinks that, if he buys a condo with the remainder money, that's going to be his best investment. But I'm telling him that's not necessarily the truth. So, yeah.
Well, from what I'm looking at, he might be better advised to rent an apartment or something and invest that money. You can see what that money can become. But if he puts that money into a condo, all of a sudden he's got the expenses of that condo. I did a show a few weeks ago where we calculated the cost, or we determined the cost of living in your home. What's it cost to live in your home? And it costs a lot more than you think, even if it's paid for, because you got taxes, you got condo fees, you got repairs, you got utilities. Okay, there's so much, and Stats Canada says that the average cost of living in a house is around $3,000. So just go to Stats Canada. Okay.
Yeah.
So if he can rent a place for $2,000 or $1,500 as opposed to spending $3,000 to own a place, that's worth considering.
Yeah, and that's what I told him. I said, you don't need to invest all your money. You can keep some money off the side for your living expenses, and while you're going to college, and still work part-time, but invest the other part. So, okay.
Yeah, it's the old budget issue. Lisa, I can't tell you how much I appreciate your call. Thanks for calling.
Thanks. We'll make an appointment.
Okay, and we'll make sure you get that book.
Okay, thanks.
How to Choose a Financial Advisor. Call Fred Schneider.
I know. It's so hard, yeah. Okay, thanks, Fred.
Okay, appreciate your call.
Okay, bye.
Okay, bye-bye. Okay, so, again, if you just joined us, I'm Certified Financial Planner Fred Schneider, also a Registered Financial Planner. We've been doing some number crunching, kind of wandering all over the place. We had some technical issues to deal with earlier. We got them all fixed happily. And again, if you want to take this to the next step, what you do is make an appointment. you give Frida a call. There's no cost, there's no obligation, there's no reason to be fearful. Give Frida a call. You can talk to Frida right now, area code 604-737-3512, and she'll be down at the office for the next few hours. So give her a call. And again, I would like to thank you all for your participation today. I'm certified financial planner Fred Snyder, also registered financial planner. We have to go. See you same time, same station next week. Bye for now.
If you'd like Fred to review your portfolio, call his office right now at 604-737-3512. That's 604-737-3512.